All right, everybody. Happy June 20th. Welcome to the May 2024 Jobs Report and Inflation Update. My name is Albert Chen, and I'll be your host. I'm with Albert's List, and with me today is Colin Moe, our assistant economist, plus Dr. Reilly White, who is the assistant professor, associate, excuse me, wow, you get that wrong, associate professor of finance at the University of New Mexico. As we always do on this webinar, we review the state of the economy, how it impacts your job search, and then looking forward to what may be happening in the next few months. You, as always, in the audience, are welcome to ask your questions, talk about how much the Federal Reserve is gaslighting you, and what trends you are seeing on the side in your own market. We're gonna as always, have this recorded for you within 24 hours and on our YouTube channel, where you can watch the replay as well as highlights. Without further ado, Dr. White, welcome back.
All right, welcome everybody. Thank you, Albert. The incredible introduction. Thank you so much, Colin, for asking the hard-hitting questions that some people out there might be afraid to ask. And again, as always, as in every session, if it's your first rodeo with this, we're so glad to have you here. If it's not your first rodeo, just enter your questions into the magical webinar chat or in whatever way you find easiest. I'm happy to answer anything. There's no such thing as a dumb question. Let's rock and roll this. I even got a screwdriver I'm using to conduct with, because that's the nature of today's job situation. So we got a whole slew of very interesting questions across the board. I'll do my best to answer them. If I don't get to your question fast enough that you may have asked beforehand, just let me know and we'll do it. So let's start about this with our traditional AI-generated Albert's List front. Again, this is the jobs report from May that we give in June, because that's when we have most of our data. Some notes about the jobs report too. As we get jobs reports coming through, they're often revised the next month and the following month as more information comes to light. What happens is to assess the job situation, the powers that be, for instance, if you're assessing, for instance, the current Bureau of Labor Statistics data set, they do use surveys to do so. And they use surveys that are statistically accurate, but at the same time, in the tendency of economics to aggregate things, we often lose sight of what's actually happening at a more nuanced individual level. And that's really starting to show up with what we've seen so far. So starting this right across the board, our May 2024 jobs report. Oh my goodness, we got Aaron. Aaron's in the house too. Oh no, what happened? Oh my goodness, this is gonna be, it's happened. It's real now. It just got real. That's what we do. Yes, we try for the early 20th century craft fonts, like something you found in your yard. This is a barge. It's taking jobs out of San Francisco, but it's good for you to see it there. Oh yes, look at this. Trina Solar. This is great. Awesome. We got Trina Solar representation. Caroline, that's awesome. Very cool. Look at this stuff. This is excellent. Very cool. Love this. Chegg cut 450 workers today, so that's something too. Wow, Albert, so that's Chegg right there, making things happen. I know, as a faculty member, I've had many shenanigans. I've had many discussions with Chegg back and forth about various things. I'm like, can I get access? And why is my stuff online? Why do you have all the answers to my questions? But college textbooks, important for you, important for everybody. So when we talk about this jobs report today, let's break it on down. You heard the headline number in May, and you probably were asking yourself, that doesn't seem right, but there's a lot of reasons for that. Some of that's very regional, especially if you're California based, and a couple of those things will seem very, very skeptical to you. But I promise you, although the data is good, if we dig deeper, we're going to notice where those irregularities happen and where we're seeing some of that bad news. Oh man, that's great. Hiring a 5-gigawatt solar panel manufacturing facility in Wilmer, Texas. Make it happen, Caroline. That's good. And hire our Albert's List group who's on board today. So if you know a bit about solar energy and want to move to Wilmer, rock and roll it. Make it happen. Better than expected. So our jobs report added about 272,000 jobs. One thing is what does this mean, 272,000 jobs? Is that a good number? Is that a bad number? The short answer is, in an economy with low immigration, it's a good number. In an economy with high immigration, it is a okay number. And we think we're actually more of an economy that is experiencing a level of higher than anticipated immigration, which is what we've seen over the last couple of years, which makes interpreting this number a little weird. It is not a bad number, but it is not as good, perhaps, as you might compare it to, say, a couple of years ago when immigration numbers were much lower. And as a consequence, a lot of the job market, and for instance, the Economic Policy Institute pointed out, they did a study involving last year's data. About 50% or so of the job increases that we've seen across the board are likely to have been derived from higher than anticipated immigration, both illegal and undocumented. So unemployment rises slightly to 4%. That's interesting. So although unemployment rises, people kind of shoved it off. Oh, I'm not worried about that. That means unemployment is the number of people who have a job or are looking for a job. Who are looking for a job divided by the number of workers. And when you're looking for a job, you have to be within the workforce, and you didn't fall back from the workforce. There's a lot of interpretation at the margins if this means that more people are now looking for a job that don't have one. Or what's happening, and this is actually what's really happening in a lot of senses, we have a lot of people now engaging with the full-time, part-time work dynamic, where a lot of full-time workers, for instance, or a lot of people who might be full-time workers are actually getting part-time jobs and vice versa. Full-time employment has been relatively stagnant. Part-time work has increased, which is very interesting. So this is good. JOLTS is rocking. This is cool. So Aaron points out, of course, our JOLTS number, Bureau of Labor Statistics. JOLTS, by the way, is job openings, labor turnover in April 2024. As if you click on Aaron's link, I can vouch for Aaron's links on the chat. They're always relatively safe. And always very, very relevant. And in this particular case, we're looking at job openings and hires and separations. I'm going to get into another chart about that, because even though the trajectory is downward in these factors, it's still numbers that we shouldn't be necessarily disappointed about. Albert says, Dr. Wright, don't forget information laid a big flat egg last month too. We're going to get there, Albert. You're right. Oh man, that gives me the sweats. So you're like, okay, 272,000 jobs, Reilly. Where are these jobs? I'm working in an industry that has this. And this is fascinating because healthcare and social assistance has been running away with this thing. And that feels bad. We know we're all getting older. We know we're all getting less healthy. We know we need a bunch of things. I need a team of doctors to keep me alive and enthusiastic on a Thursday evening. And so as a consequence, we're seeing an explosion in social assistance and healthcare. Government work has been okay. Leisure and hospitality still bouncing back, and we're seeing that. A lot of that's due to some summer demand that we expect. There's a ramp up, especially in these sectors of employment as we approach summer. Now, it is true. Stephanie's absolutely right. What is very encouraging, Stephanie, as you're absolutely right, is we've seen professional and business services, an all-encompassing paradigm that includes a number of jobs which you might fall into if it's outside of, say, if it's in a lot of broadly business support, everywhere from necessarily, business management, some parts of accounting, some other things. It is a vast and important role, and it is showing some growth, which is useful. However, we're seeing losses in some very interesting areas. Although mining and logging, I know our Albert's List mining and logging group has been disappointed for months now. We're seeing some negative turnaround there, but information in particular has been particularly disappointing. Here you've got a lot of tech firms overhired. They laid off a bunch of workers. Cost of capital rose. That increases cost for investment. Investment costs are across the board. You're dealing with a sector that itself dominated by a lot of big players, including a large number of companies that we call the Magnificent Seven in the stock market, because they performed so well over the last couple of years, not hiring to the levels they were before, and where they're hiring is different. And we had a question in the chat not in the chat, but that Albert gave me or sent me earlier this week from one of your previous chats to Albert. That was like, hey, can you break this down? I'm interested in these sectors. Let's look at IT. Let's look at IT services. I look at that later, and we'll talk a little bit more about that. In short, a lot of the projections going forward on information are relatively more positive than where they are now. But that's sort of the nature of projections. I look at everything, and everyone's like, how's the economy going to do? Information sector as a whole is likely or perceived to be that it will improve, particularly if some of those interest rate costs start dropping. And it's going to be interesting to see if the Fed is going to do that. And we'll talk a little bit about more of what that means. Is e-commerce under retail services? That's a really interesting question. Let me look at the definition right now. And we'll grab this as well. So e-commerce workers, so let's see, they played here increasing to 80%, wages in e-commerce, blah, blah, blah. So sectors, e-commerce should be part of retail, in short. But the way they divide that, so if you work for an e-commerce company and you're dealing with a primarily retail or consumer-focused platform, you'll be classified as retail services. If, on the other hand, you're working for that same company and you're involved in their legal if you're a paralegal working for that company, you'll be classified as professional business services. If you're classified as an analyst in that company, you might be under some level of financial activities or professional business services, depending on how you're qualified. And so that's a very good question, Sabina. That's a very, very good question. And so within this, you have these separations that seem very artificial. I'm going to link you both real quick to... Let me get the right website here. Professional Business Services under the Bureau of Labor Statistics. It'll tell you a little about this because there's a lot of scientific jobs in this as well. It includes management, professional, scientific, and technical services, administrative and support, and of course, waste management and remediation services. So that's your super sector right there, professional and business services. So take a look at that, and that's interesting. And it tells you a little bit about how they're doing. It's a wide-ranging sector. Disappointment for information, educational services in trade, manufacturing hasn't been hot. Some of that could be due. We have the continued strong US dollar. That makes it very hard for US manufacturers in particular to compete globally because our stuff is more expensive. At the same time, we're also pursuing a more isolationist trade regime that's concerning from an economics point of view. It does make things more expensive, and that's the thing as well. And I also want to kind of reiterate as an aside to this, sort of, I'm going to approach the mainstream economics thinking and mainstream economics literature on this. So in the last few decades, we know in general, initially, research had always shown, hey, free trade's the best thing. We should open our trade borders with other countries and make deals. As it turns out, what happens is, as it filters through the rest of the economy, that awards some people a lot more than other people. It has the effect of increasing inequality in an economy. On the other side of that equation, though, things like tariffs are also bad for the economy, because even if you protect one industry and you put tariffs on the industry and you say, hey, I want to protect automotive jobs and make every other imported car more expensive, what that does is it increases all those input costs across the board for everybody wanting to buy a car, including companies buying fleets of cars. And it also pressures up and down the supply chain on that value. And so you end up saving 10,000 jobs and losing 40,000 in other sectors of the economy, which makes this particularly nefarious, which is really interesting. Japanese yen at a 30-year low against the dollar. Keith, you're absolutely right. I traveled to Japan in March. I felt like the richest man alive, Keith. I was out there. I'm dropping hundreds of yen everywhere, and it felt great. I bought, luxury everything. It was great. The finest tea in the world. It was magnificent. It was a great time to travel abroad. The richest man in Tokyo. I felt so good. My hotel was wonderful, and it was like $70 a night. It was just like the greatest day of my life. Caroline, that's excellent. Thank you so much as well. I echo Albert's enthusiasm for that. Thank you. That's great. Caroline, thank you so much. It's always good to see this type of engagement, especially as it helps people find jobs and get things happening. So labor force participation, that's the amount of people who of the percent of our population who could be working, who are actually working, is about 62.5%. Now, that includes, of course, people who are retired, and so a lot of people drop off in retirement. We've seen a tendency since the year 2000 for this number to drop. We reached the highest participation level in basically right before the 2001 tech bubble burst. And since that time, the boomer generation has gotten older. They're retiring. That drops the number of people in the workforce. And right now we had seen some improvement, but it actually fell back 0.2%. And in the last couple months, this has been a little wobbly. And so that's something we have to watch going forward, which is why I highlighted here just now. Also, wages in particular. Hourly earnings have increased about 14 cents, about 4.1% in the last year. Those wage increases, we look to wages as a source for powering long-term inflation. What's the Fed going to do? So we had a very disappointing hourly earnings report last month where the annual wages were increasing around 2%. Now they're up a little bit higher. 14 cents is better, but over the last year, it's only about 4%. This is okay. This is a good economy. Wages are rising, and they're rising faster than inflation is currently. All of that bodes well for the economy in the long run. However, there's always a however, right? What's the deal with the economy? And this is kind of the big picture here. Why are we experiencing a kind of a divisive role in the way that I see a lot of good numbers here, but I feel like this is very stressful. Oh, this is good. I actually highlighted this on my Twitter, Aaron, where I feel like there's no engagement and I'm just shouting into the universe. Research and development value added. New Mexico, California, Washington, leading states out west, where the state's GDP is based on R&D. A big deal. And I love that chart. So Aaron's got a solid chart there. So coming down here, let's talk a little bit about California and what's happening now. And so I had a question this week that said, Reilly, do you notice? No one, they didn't say Reilly. No one says my name unless they're, unless they're mad at me or, somebody's yelling at me. But they said, hey, guy on the Zoom chat, do you notice any differences in the economic situation across different metropolitan areas? And I go, why, yes, I do. And so I just grabbed a whole bunch of data. This is all of the April data for all of the nearly 400 metropolitan areas we have across the country in the United States. I took out Puerto Rico. I don't want to, no shame to Puerto Rico. I kept it to the 50 states only. So among the 50 states, I highlighted these are sorted. These are all the metropolitan areas in the country sorted by April 2024 unemployment rate from highest to lowest. And I put the top 20 here, the top 20 metro areas with the highest unemployment rates. And as it turns out, and just for a hint, I highlighted the ones in California in yellow or tan or tannish yellow or beige. And I did this just to show you. As you can see here, it is astonishing the level of unemployment that exists in inland California, particularly, as Keith points out. There's only a few, indeed, only 6 metro areas outside of California experiencing this. One is on the border of California, which is Yuma, Ocean City, which is in New Jersey, and not the one in Maryland. I did share. Yakima, Washington, Kokomo, Indiana, Rockford, and Kankakee, Illinois are also there. So what a fascinating story. And this is interesting because when you look for these things, it's not like you're setting up shop in El Centro saying, man, the inland, I mean, this is great. We got it there and not so far from the Salton Sea. Maybe this is a place to go. A lot of these inland economies have been hit heavily and especially hard. And we look to this in aggregate, even Visalia or Merced, Bakersfield, Hanford, all of these areas, all across the Central Valley experiencing just almost double-digit unemployment. And look at the trajectory between April 2023 and April 2024, and it is strongly negative. It's almost an exaggerated version of the unemployment trajectory we've seen across the country. So you've seen El Centro jump 2%. You've seen all of these jump basically 1% or more. And notice that the trajectory of unemployment is getting worse in California, whereas in places like Yuma and Ocean City, it's actually getting better. And you're dealing with just a complex series of fascinating issues right now, and it's a fascinating time. But you look at this and now compare that to, and it doesn't mean necessarily that a place necessarily is undesirable or desirable. To have high unemployment means that a lot of people are looking for work and those jobs are not being there. So a lot of agricultural, Central, of course, being in the middle of an agricultural area, the Imperial Valley. And looking at other agricultural regions in particular being hit heavily. So big food, big agro in particular, hitting it pretty hard, right? And if I go down, I mean, that explains most of this, with the exception, I can't argue that really for Santa Cruz so much. But a lot of this is what you see. Now, if I flip that around and I said, okay, what are the 20 best metropolitan areas in the country? You're going to get a series of entities that are areas that you wouldn't necessarily view as being places that themselves are desirable to live. You'd be like Jackson and Hattiesburg, Mississippi, have 1.6% unemployment rates. A lot of areas of the South and Midwest, basically, that possess this. Very average towns with steady amounts of work, steady jobs, and steady income. And you're not seeing mass layoffs, you're not seeing mass changes, but you are seeing kind of an economy. And a lot of these places aren't even, their labor forces, in fact, are relatively stagnant. They might be growing a little bit, they might be shrinking a little bit, but you're not seeing big changes in the labor force. You're not seeing big changes in the structure of the labor force. These are just sort of steady, areas of the country. And it's a fascinating duality to look at the issues we have along, say, the West Coast and compare that over to the center part of the country, where it does feel that things are actually, incidentally, unemployment rate is quite low. Now, I will note that these places often offer fewer job opportunities, fewer locations, fewer opportunities for switching, and as a consequence, unemployment is less transitory by nature in these places, in the sense that people feel comfortable waiting a few months for a more ideal job, knowing that there are few options that might be available to them. Interesting links. Oh, this is cool. Look at this. Aaron highlighting despite near-term sub-trend growth, UCLA Anderson sees no recession on the horizon in 2024. I agree with that. I don't see a recession next year anymore, but I do think we will be there will be some challenges depending on the economic policies that we put through in the next couple of years. But that'll be more long term. So this relates to one of the questions I get often per this question. How do you view the economy? We view it through different lenses depending on the situation that we're in. If we're a member, we know somebody, or we're in a sector that feels particularly depressed, we tend to feel that the economy is not doing well. It also depends entirely. A lot of times, we are very polarized as a country. Our interpretation of the economy often depends through the lens at which we see the president, to which we see Congress, to which we see our governing bodies at managing or not managing the economy well. So a couple of quick notes to note. So one thing is the economy getting weaker? So the question of not if we're having a recession or we're not having a recession, is it getting weaker? And in general, in terms of at least some dynamics, including, say, job openings for unemployed worker, we've gone from this, and I'll highlight this chart here, we've gone from this incredible situation we had post-pandemic. We laid off a ton of people. Then $5 trillion of stimulus spending, whoosh, fly through the economy. Money's flying everywhere. We have nowhere to put it. Then we got inflation. But then we had almost, for a while, we were cruising around 2 job openings per unemployed worker. And this was a discrepancy between what companies wanted to hire and what workers were available. That since has fallen down to basically where we were in February 2020, right before the pandemic shook the soul of the United States. And we're about right now, we still have more openings than unemployed workers, but that ratio is very narrow. We're almost at a 1-to-1. We're about a 1.2 ratio right now, and that is continuously going down. This is more normal for a standard good economy in 2018. Say it is not exceptionally good, not exceptionally terrible, but it's also one that's more sustainable. I suspect this will level out. I don't think this trajectory is going to continue drawing a line down where we crash into a recession. I think we're going to level out as we approach one, and we'll see what happens there. Helicopter money bags. Albert says, do you know what the ratio is in specific industries like tech? What a great question. So yes, I can grab that. God, I saw that chart and I said to myself, now I got to find that chart from the depths. Let's see. So openings, hiring charts across industry. Hold on. I'm trying to find this. I have it in my chart Rolodex. It is, and the good news is that when we graph separations and hires, And that's the hard. Let's see if we can grab this. There's a nice little chart they do on this. I'll have to bring that for you for tech specifically, Albert. That's a really good question. It's always when I always see it on like Twitter when I least want to like something, and I just don't. So that's a good question. I'll have to grab that for you. Did you grab it there? Yeah, that's yeah. Oh, you got. Oh, look at Aaron's just grabbing it. Yeah, that's great. Those are useful. I appreciate. Aaron's going rogue. He's like, here's what I'm going to talk about, and it's going to be these. Take a look at this. Let's see. Economic policy, maybe. I'll find that for you, Albert. I don't know where it is now. I got to take some more time on this. I'll make sure I like that earlier. In general, I do have a chart that shows separations in hires. Typically, where we see greater workforce separations, we also see greater hires. Overall, even in tech, we've remained above a 1-1 ratio, but unfortunately, this is getting weaker. And when we think about this for certain industries, Americans' ratings of national economic conditions have slipped since January. This is from Pew Research Center, conducted in May. And of course, depending on your political persuasion, actually, whether you're Democrat, Republican, or independent, your perception of economic conditions right now are worse than they were in January. Now, ask yourself if that feels true for you or not, but that is something worth considering. Are our economic conditions good or excellent? In a strong minority of Americans, not a majority across all political parties, view us in a challenging economic situation. And when it comes down to a whole bunch of different views about everything from inflation down to a whole number of issues, partisan connections are often very predictive of how people view these things. That's good. We got some LinkedIn requests in there. Yeah, of course. You're welcome to reach out, of course, to LinkedIn. You can reach out to me and, of course, reach out to other people in the chat taking advantage of this opportunity on LinkedIn and elsewhere. So let's think about that. So put that in, put a pin in that for now. Let's continue onward and talk a little bit about inflation. So good news about inflation. Yay, 3.3% year on year in May. We saw after it was choppy. We knew it was going to be choppy. We said it was going to be choppy, but the tendency was going to be downward, and it is indeed downward. Not yet at the 2% target for the Fed. Again, if we go back to the Cleveland Fed's prediction 2 years ago, they were going to say that would happen in 2025 without a recession. I think that's pretty accurate. We got some time before we hit 2, if we do or if we need to. 3.3% year-on-year inflation is still pretty good. Remember, wage growth on average is 4.1%. As long as wages outpace inflation, we should feel richer, except we don't. And there's a few reasons for that. So food prices are up 0.1% month for month. And 2.1% compared to a year ago. A lot of the growth we've seen in food prices has been in stuff like food outside of home, food inside of home, food within the home, food in various buckets and sundries, food inside of your desk. All of that apparently has gone up only 2% in the last year. Energy prices are down 2% on a monthly basis. That helped inflation. But over the last 12 months, they're still up about 3.7. Shelter costs are still rising. They're about 4.4% up compared to April and 5.4% compared to May. But again, that's falling off. That's all delayed from the pandemic. But here's where we feel this. Here's why this is such a big deal. So the Consumer Price Index, as an index, when it takes this basket of representative goods and says, here's what the American buys, and it says 20% of their income goes towards this and 15% of their income goes towards oranges. They calculate a representative basket of goods that represents what Americans are going to buy. And they compare it, how much this basket of goods has increased over time. And the part is, with our finance and economics thinking, we're often very focused on just what happened in the last year. Everything that we record, from this data here, 3.3%, to financial instruments that we have when we describe things like the interest that we get on bonds, we annualize even semi-annual bonds. Everything is based on an annual paradigm. In inflation, people don't feel things annually. People feel things in aggregate, often collectively over a number of years. And so even though the trajectory of inflation has gone down considerably, even close to flatlining right here, as we did in the last month, that trajectory we feel, even though our price increases have been minor in the last few months, we're feeling the last year, the 2 years before that, the 3 years before that as well. Going back to 2021 and 2020, when inflation rose steeply, Fed started raising rates. That changed the slope of that line significantly. Inflation started increasing at a lower rate, and it got more under control. That's fun. Albert says McDonald's is coming out with a $5 meal deal. That should help. Carolyn says that isn't real food, minimal nutrition and toxic. Aaron says the role of the tech sector in shaping the California economy. Look at these solid reports. Aaron's dropping you guys homework. I want you to read everything Aaron puts in there, read twice, and get back to me next time. It's solid. So this is actually good. Solid reports here as well. People feel multiple years of inflation, which is why that even though we have things under control, it means that we still feel poorer. A few other notes about this. When surveyed, there's a famous study that was done by Robert Schiller, no less, back in the late 90s that asked the question of Americans. And they said, in Americans in general, then they asked a bunch of economists. They asked a bunch of Americans first, and they said, hey, would you be happy if prices dropped? And Americans were like, yeah, I'd be happy if prices dropped. The vast majority of Americans said we'd be happy if prices dropped. And then they asked a bunch of economists, and the economists were like, no, we wouldn't be happy if prices dropped. Here's where the difference comes around. Once prices are up, they stay up. They don't go back down, usually, unless you have an economic crisis. And that's a good thing because we want the economy to continue to invest. People put their money in something because they think it'll be worth more in the future. When you have deflation, people lose the incentives to invest anything, and we end up in this dark spiral where investment doesn't happen and then unemployment rises. And we'd end up having to flood the market with stimulus spending in a Keynesian way to help boost the economy. And this is often a hangup that we get with a lot of understanding of CPI among just normal people who don't surround themselves with economic and financial data on a year in, year out basis. So prices are not going to come down, but we do want this to be this trajectory to slow down. And the longer wages remain ahead of inflation, the better the economy will perform, the better people will feel about the economy in the long run. But it takes time. So Albert says, so is that why the Fed sounds like it feels so out of touch? They take the aggregate. Well, me and N equals 1 feels like I can no longer afford to pay my bills. Absolutely. The Fed's like, hey, inflation's only increasing 3% a year, and we're increasing jobs. And Albert's like, but we're still 20% above these prices where they were a year and a half to 3 years ago. And as a consequence, I still feel poor. And does the Fed's aggregate include billionaires and millionaires, which skews things upwards? That's a really interesting question. So when we think about billionaires and millionaires, I mean, offset these things. Certainly the interpretation when you think of where policy making decisions reside, people in a powerful position, aka the millionaires, the billionaires, the other people, they'll be in a position where they'll say, they'll see things through their lens and their feeling of success and triumph come through their lens, which might be based more or disproportionately on, say, good stock market performance than say, oh my goodness, the price of my car has increased drastically. Aaron says tech has less than 8% of the jobs in California, but 20% of the GDP. Look at that. So productive. Albert says, Dr. White, after all these Albert's webinars you've done, we should write a book called The Labor Market for Normal People. That's a winning idea, Albert. Let's do it. We'll have Colin in there. Colin will write the first chapter. Colin will write chapters 2 through 31. I'll handle the first chapter. You handle chapter 32. We got this thing. We'll split the book price evenly. It'll be great. It'll be on all the stores. It'll be in a derelict bookstore shelf somewhere in an abandoned downtown San Francisco office space. Oh, look at this. Aaron digging deep in the Chapman University Digital Commons for this one. It's good. Industrial jobs are, let me blow off the dust on this one. No, it's good. This is really good. Oh, Stephanie, hit me up if you need an editor. Maybe we will, actually, Stephanie. If you've got the skills, we'll pay the bills, or Albert will. We'll think of something like that. That'll be good. That's good. So that's like industrial jobs. That's a great article, too. I have to check that out. I'm just kidding you. This is actually very interesting. God, it's written. This is a fascinating article. You sent me this article that just came out in 2024, but it uses a font that looks like a econ policy manual from 1987. This is great. Stephanie, been editing 13 years. You write novels, Stephanie. Yes, make it happen. Yes. Bring it about. Have that. It takes courage to take a chance and sit down and write it. It's so hard to do. Goodness knows, even when I write academic articles, it takes forever. I have great respect and appreciation for those of you who do it on the in and out. So, Stephanie, that is awesome. Albert says, making jobs on Zoom right now. This will reflect on the June market labor report. Professional services +3. That's right. Oh, man, this is great. Albert, Aaron, again, some solid reports to travel and visitation forecast. This is true. I'm going to take a second. Aaron dropped a link in there before we dig in deeper about CPI. Aaron also sent a link about tourism and hospitality is rocking. That's true across the country, as it turns out. One of the great and joyous surprises after the pandemic, the sector that was hit incredibly hard, tourism-based sectors. I live in Santa Fe, New Mexico, a tourist area by nature, hotels and everything. I consult with the city and among some other cities across New Mexico too. And we do a lot of budgetary projections. And one of the things that powers a lot of cities in the country, particularly as it relates to revenues, comes from lodgers tax or equivalent tax on things like hotel rooms, and also taxes that might happen from economic activity, sales taxes or GRT taxes from restaurants and other places, both captured in leisure and hospitality. Now, higher tourism spends, and because California is a desirable place for tourism, you are seeing that where we did see boosts across the economy in California and the rest of the country is in leisure and hospitality. And the tourism spending as a whole has been tremendous. That recovered so well. It's appealing for national and international tourists. And tourism is actually one of those things that does normally okay in recessions that weren't like the last one. Last one, where we had a pandemic that closed down the leisure and hospitality market, we saw these sectors hit disproportionately poorly. If we go back to 2008 and you study, say, for instance, the revenues derived from lodgers taxes in those places across the country, you'll notice that there wasn't really a big change. Upper middle class, upper class folk who do a lot of traveling. Traveling is a luxury. They don't necessarily change their behaviors in economic situations and economic conditions. So not only is it going up, but barring another pandemic, knock on wood, I would suspect that the California leisure market will continue to rocket for years in the future. Now, when it comes down to this CPI, there's a few things to note here I want to kind of talk a little bit about here. So CPI, we look at year-on-year CPI in blue here. We know that we've gotten this under control. We know that it was really high in 2021, 2022. We know that since it's dropped down to a level that is still higher than our dotted line, what we want it to be, but one that's manageable. Notice when it comes down to a couple of things here, one of the things that we care a lot about is this question called owner's equivalent rent. So this is kind of the measurement of the change in the shelter cost consumers experience. And shelter costs were delayed. We saw at the beginning of the pandemic really low mortgage rates that put a lot of people bidding the housing market upward. Housing market was bid up so much that people could no longer afford homes. They went into rental units. The rental unit shot upward as well. And although these rates annually have come down, these shelter costs increased proportionately high. And those are starting to come off on this end here. And we expect that this trajectory will continue, and this will continue to make things a bit more affordable. That's the positive note that we can make about this. Now, another note about CPI, grabbed this from Bloomberg. Contributions to US CPI, and we look at a few things here, we'll notice that when it comes down to the consumer price index, the amount that we measure inflation by, shelter remains the biggest chunk of our CPI. That's this kind of orange value here. We saw it shoot up in 2022, 2023. It's coming down and it's coming off. And we noticed that a few of the things that were helping to drive inflation upward, like transportation services and personal services, are now helping to drive it downward. We're still seeing increases in things like education and communication, but we suspect that this will help get this thing under control very soon. And that's ultimately what our hope will be. Oh my goodness, this is great. Albert says the housing market is really scalding, it seems. And that's the weird part about housing. That's the hard part. So even though because of incredibly low inventories, prices have remained high, even though our interest rates are still 7% for a 30-year mortgage with a good credit score, making it very, very hard to buy a house if you are in a situation where you're buying it for the first time. And it's just really, really, really terribly challenging. Colin, I'm sorry.
No, it's okay. I think I have two questions, and I guess question one is,
Yes.
what are the conditions for Americans to view the economy like favorably. Because earlier you were showing that graph. Uh,
Yeah.
which like we can look at the graph and see clearly not everyone's happy. You know, the overwhelming majority don't think it's happy. I was looking at the historical graph, and the last time some people thought it was great was 2018, and it was
Yep.
overwhelmingly Republicans, but Democrats at the time like disagreed. So I guess like the first question is, has there ever been a time when both sides agreed the economy was doing great, like overwhelmingly?
Hmm.
And then number two is there a an actual path to bringing inflation back down to 2% besides just keeping everything high, waiting for the slow boil and keeping everyone feeling like a frog in the
Right. Right. And so certainly the attitude. So at the end of the day, the attitude of how a bunch of very well connected, whether what you hear in across the sphere on media, on everything and voices, all of those things contribute to our understanding of how we feel about something and how we feel about an economy. And the nature of that expression has changed drastically in the last decade. We used to think, it used to be very internalized 20 years ago, 25 years ago. Social media changed all of that. And I think we have an expression now, even though we get our news from various places and our news itself has become very politicized. There is a tendency that now actually worse than any time that we have on record, the discrepancy between the political parties on this is intense. Like if we go back in time and just look at, so we know in general, let me zoom in, I'm going to grab a quick chart for you and see if I can. So this is a survey that was conducted right before the pandemic, Colin. And this is historical, how do you feel the economy as excellent or good? Now, we had, of course, an election in 2016 and then 2017. So you went from Democratic president to Republican president, and immediately the perception of the economy changed drastically. Oh, we had a terrible economy, now we have a really good one. Or, and vice versa, it also went down, of course, for the opposite party. And this sort of tendency has just continued depending on the political situation and the perception of what leadership that we have. So you asked a couple very intriguing questions. The first was, have we ever really agreed that the economy is doing well? We have been more partisan now, and there are different flavors and times of partisanality. And I suspect, I don't have the data in front of me, but I suspect at various times in the post-war period, we had a general sense that defied, certain tribal instincts we have, depending on certain issues, that the economy was doing well or not doing well. To your point, though, Colin, to ascertain this, you really got at this here. What needs to happen for us to say this economy is doing great? Like what needs to happen for the majority of people to look at this, answer a survey honestly. Pew Research calls them and says, is the economy excellent? And they go, yes, economy. I think the economy is the best we've ever seen. What does that take? I would say 10 years ago, I would have said the economy of February 2020 or the economy of now. Now we're so partisan. I don't think it can be addressed exactly. Carolyn hits the nail on the head. We're so tribal now. How can we address a factual situation about the economy in general? And this is the interesting part. So I would say that economists and finance people, we have a general sense of things because we study this all the time, and we say, well, right now the economy is, when we compare it over history, doing well. We're not in a recession. Merely me saying that is something that many people would find quite divisive, and they'll disagree with me on that.
Yeah, well,
I
later down the
yeah.
line we have a debt talk.
Yeah, we got to do that. And so that's hard. And so we are in some of this, and this is a broader question to this. And I actually open that up to everybody's perception of what they think would make them feel confident about it. So even if you have a job and you look at yourself right now, are you in a better material position than where you were 4 years ago, 6 years ago, 10 years ago? And you say yes, but you still might say, I don't think the economy is doing well. Think about why you feel that way. What is it about those signals that make you feel that way? What have you read? And I have to say, and I'm not a cognitive theorist. I don't have some of you in the audience, I suspect, have much greater psychology training than I'll ever do. I mean, we have a subsector of behavioral economics and behavioral finance, which deals with a lot of these perceptions. And we know that these perceptions affect the way that we interpret and make decisions in informed ways. But I imagine that the psychology of it factors into it. So it would have to be, my guess is, Colin, it would have to be nothing short of a absolutely lightning bolt event that drew the economy that drew the people of the country together towards a common purpose. An alien invasion, Colin. I don't know, like literally something that would cause a 9/11 type event that would force Americans in a position where they viewed each other as allies and for a moment in time, in a situation where we were non-combative against one another, maybe. But I think that regardless of the economic situation, we are now so highly politicized and tribal. I don't think we can get to a position where this is going to be general agreement right now.
It's not the Dow Jones reaching new all-time highs.
Not even that. And people know this. We have more people. So we have a greater percentage of our population in 401ks right now. They're 401ks themselves, component pieces of which are based on the Dow Jones and the S&P 500 are reaching highs. That should provide people comfort. It does not. We have a lot of reasons that we need to do better as a society, right? We have healthcare, we have other things that concern people. We have rising prices. We have anxiety across the board, period. We're just these little anxiety-driven, primates that just, that can't find joy and satisfaction in a great deal of things. That's a fantastic question. Aaron says, if we look at 3 other populations, the Great Depression, mid-60s to the 80s, and 2008 to 13, they never changed their minds. They were fixed and stuck in the rest of life, and the economy is always bad. Could be some of it as well, right? You end up in a situation where you're exposed to something, a traumatic economy, and as a consequence, we never truly recover. That's a great question. I'm not offering a lot of good answers for that, Colin, but I think it's a very philosophical question. I don't have a good answer. What do you think, Colin? I'm interested. Why do you think we'll get there to a point where something could happen where we agree generally the economy is, and I'm just going to say good specifically, it's very easy to get everybody to agree the economy is bad, which right now, despite 4% unemployment, people agree with.
Maybe because I'm like, in tech, so I like to look at things like, well, okay, what's the metric or barometer for saying, okay, this is good or this is bad, right? We have numbers for that. So it's like Americans' ratings of good or bad, I think that's just like based on feeling. Like, how would someone personally say, hey, I'm currently doing well in life because the economic conditions are, enabling a good lifestyle and I feel confident about my next 3 to 5 years or blah, 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 blah. But like, maybe that's just a different conversation. The second question I had was, do we actually, so I guess the question is more for you as an economist, do you see a path and a plan for the Fed to bring inflation back down to 2?
Yes. And so you see a plan or something for yes. So right now, I do believe that the Fed, especially through the Fed's inaction of taking any action on reducing the rate. So let me go back here for a second for everybody in the audience who has come here later or have a chance of adjusting with this. So the Fed, of course, they rose rates in the prior, starting 2 years ago and now ending about a year ago. They rose rates at the quickest rate that we had ever seen in the last 40 years. And what are rates? What are these interest rates that the Fed chooses? The Fed decides just one rate. That's overnight lending to large banks. They call it the discount rate. That has a ripple effect on every other interest rate in the economy. So what it does is when the Fed increases rates, they increase the cost of doing business. They increase the cost of investment. In addition to things like loans costing more and overnight lending costing more, it makes a lot of projects that might seem like really good ideas not seem like good ideas anymore because it's harder for them to make money. And as a consequence, it reduces the money supply. And as a consequence, that helps reduce inflation. When the Fed wants to stimulate the economy, they lower the interest rate. And as a consequence, and what that does also I say as a consequence again, is that when you lower the interest rate, you reduce the cost of investment. A lot of projects that didn't seem like good ideas now seem like good ones. Building happens, money sloshes around, and then our economy grows. And so right now there's a battle fundamentally in the Fed between people who want to start easing off that lever and want to start reducing rates, and those who want to keep it longer for higher for a longer amount of time. There's several schools of thought in this. If you've been around for a little bit of time, you know that the current interest rates in particular aren't historic highs, but they are, inconvenient compared to where we were beforehand. It is important to note that when you have low interest rates, that means usually, or what that incentivizes to happen, is asset prices, stuff like homes and expensive things go up in value. Because low interest rates means you have more purchasing power. You can take out a loan, and that long-term loan can power a bigger property and a bigger unit and a bigger house. And then when rates increase, that makes stuff more expensive. And as a consequence, that means you can only afford a smaller house. So right now we have the worst of both worlds. Rates have gone up and asset prices have also remained really high. And real estate markets have continued to grow, even though they've fallen a little bit among the West Coast right now, but not to levels that would correspond to the same increase that we've seen in the mortgage rates. So right now, the Fed is at this crux. They're under pressure. People are saying, hey, you can start lowering rates. They know that when they lower rates, that signals that a period of growth could begin. That'll incentivize a lot of things to happen in the economy. A lot of industries are in a holding pattern right now. People are waiting for rates to decrease before they commit to investment. For instance, we look at the mortgage market or the real estate market. We know that we need to build a lot more. A lot of builders are saying we're waiting for rates to come down before we can build more. And so as a consequence, and you have buyers saying, I'm not going to put my house on the market until rates drop. And then you've got, sellers saying they're not going to put their house on the market till rates drop, and buyers saying, hey, I can't buy a house until rates drop. And so people are waiting for the Fed to make this choice. But the Fed knows the longer they keep the rates higher, and as long as it doesn't negatively affect the job market, and it has negatively affected the job market, but our job market was really good, they know that they can push inflation down. And so far, the sticky parts of this, what the Fed has been concerned about is what we call super core inflation. That's inflation that isn't including volatile things like energy and houses, but deals with stuff like services, that haircut getting more expensive, the stuff for your lawyer getting more expensive, the professional services getting more expensive. All that stuff contributes to the Fed's perception of inflation, and they're still cautious around that. So Colin asked and say, is there a path to get them down to 2%? I think they want to keep rates higher for longer. And I think they think in doing so, they might be able to slide by with this soft landing where you don't have a recession and you end up with 2% inflation in the long run. But that means a lot of people are left in a position of stasis. A lot of rates remain high, and they're and a lot of things that are not fully corrected yet, like things like the housing market, asset prices, and other things, are going to continue to take a long time to adjust.
We've been at this rate for a year now, though.
Unbelievable, isn't it?
Yeah, we've been at
Yeah.
and it's still not down to 2%. Wouldn't a Volcker shock have done the job a lot faster?
So I like that. So Colin's referring to, and this is a good thing. So if we just went, what's a good term to call this? We went all out and we said, hey, we're going to shock the economy with a incredibly tight policy. So we're going to raise this not just to the 5%. We're going to just go 8% on this mofo, shut down the economic spending, and then lower it again as an ease off of it and get people back in investing. That might have worked, but it also would be something that would have had negative effects overall on markets. It would have affected the perception of the economy. The trouble is the Fed likes to control things predictably. And when you enter a shock situation, yes, you're calling us. We could have been done with this a year ago and called it a day. And right now we'd be talking about lower rates and sunshine and people coming out from under their rocks where they have been hiding because rates increased with such magnitude. But I think, but this is the hard part. The Fed is clearly inkling. They really want that 2% target more than I think the markets even knew they would. And they're also willing to bet a little bit more on the job market than we thought they would. And we're already seeing those effects in information and the nature of what happens in the next year, particularly does it spread to other sectors? Right now, healthcare has been delightful, but at some point, even those investments start running dry if those investors aren't paid back on those things, on these investments that they're doing it. So I think it will be a big factor, and I think oh goodness, I think it's still going to be an issue that we have to talk about. Man, the California State Fiscal Brief. Oh, Aaron, that's
So,
wow,
so
4% cut.
the path to 2%, and you're confident the government still has control over the situation.
I'm confident they think they do, Colin. I think right
Okay,
now.
that's very
So here's my separation. Yeah, no, that's a good question. Thanks for clarifying. So right now, okay, so here's the deal. They can, in my opinion, they can ease this off with a couple of well-targeted cuts, 0.25% here, 0.25% there. And I think we can lower it by probably 1%, maybe more in the next year. Periodically, still get down to 2% next year, and also not endanger the job market. Now, this is tricky. By waiting longer, the way that we're doing now, we are opening ourselves up for potential downside risk. Right now, one thing that has benefited the Fed is we haven't faced a large external shock. We haven't had an oil crisis, we've avoided, although the geopolitical situation globally kind of sucks, there's a lot of things going on, we have avoided any direct impact to the United States per se, and that has helped us in the event of a shock, an unanticipated thing, right? A banking crisis, something that happens in a situation that the Fed did not anticipate, then all bets are off.
I mean, we were dangerously close to a banking crisis.
Oh yeah, I tell you this not this March, a year before March. If the Fed hadn't come in, if the Treasury Department hadn't come in and said, hey, banks, guess what? We're going to give you financing because we know you all are in really tough situations given the rate increases right now. We would 100% get in a recession at the end of last year.
All right. Thank you for the input.
So yeah, so everything's good until it ain't. And right now we're just doing the best we can. So buyers, if you bought a home lately, or you inherited one, or something else happened, prospective buyers are still roughly tracking with mortgage rates right now. Traffic of prospective buyers is following mortgage rates. If mortgage rates go down, meaning this is an inverted chart, so 0%'s at top, 10%'s on the bottom. Right now, mortgage rates are 7%. We expect that when mortgage rates go down, if they go down, this will increase buyer traffic, which will incentivize people to continue to sell things. Don't forget, Aaron says, Southern California is 2/3 of the California economy. Woo, that's a lot. So Northeast is continuing. So here's the interesting part too. So one of the things that's been nuanced about the real estate market lately, if we look at the 3-month average regional index versus the national index, the Northeast has been rocking it in terms of real estate right now. The rest of the country has not. So we've been in a situation right now where historically, even the bumps we saw in various parts of the West and other things following the pandemic, that didn't fall through with the rest of the country. And as a consequence, the Midwest, South, and West, all disappointing in terms of our real estate markets right now. We had a question in the chat about what do you see for Generation X in the workforce? What do you see for millennials? What do you see for other things? So right now, generationally speaking, Generation X is a particularly interesting one. You're sandwiched, of course, between the boomers and the millennials. Millennials now, the biggest generation in terms of the workforce, the people that are actively working right now. Baby boomers are retiring. They're going to continue to retire, and they're going to fall off this chart as time goes on. Generation Z is coming on strong. There's fewer of them in general than millennials, but right now we expect that will continue to rise. Generation X is just hanging in there. They are steady, and they're going to start retiring soon, decade, 2 decades in the future. So what does this mean for workplace, and what does it mean for trends? There's a lot of volatility here. We've got in some sectors you're seeing baby boomer generation, other generations holding on for longer, taking on jobs, working longer. That delays passing the mantle of leadership down to Generation X beyond what you might have expected in the previous generation. So Generation X has to be more patient, as they typically have been. But that's also the case. But you're also seeing dynamic sectors. You're seeing cases for improved entrepreneurship, access, firm creation, particularly among millennials and Gen Xers, have been particularly impressive lately. And a lot of the numbers that have really surprised us since the pandemic has been the level of new company creation has been basically rocking at about twice what it was prior than the pandemic, and it's remained steady despite the incentives going away. So people are generating a lot of companies, and there's a lot of other things happening. Now, let's talk a little bit about debt here. I know I'm already at 8 o'clock, but we're going to rock and roll this. We'll handle this. We'll do this and keep asking questions as we go through this. So Colin brought up this in our last discussion, and he brought up an email to me around this. You know, we have the most debt we've ever had as an economy. But is this a big deal or not a big deal? And, you know, I hear conflicting information on debt. For instance, we have all this debt, but overall our household balances are suggest that we're not in dire shape. Why is this? And so it's true. We have a lot of debt right now, over $1 trillion in automotive loans, over $1 trillion in student loans. A lot of our markets are just incredible. However, because the biggest single component in household debt is mortgages. And although mortgage rates are high now, people who own mortgages typically got their house more than 2 years ago. And as a consequence, their mortgage rates are 3%, 2.5%, 5%, 4%. This means that our household debt numbers are skewed lower than we might anticipate them being. So back in 2006, 2007, we were in the midst of the housing crisis. We had adjustable rate mortgages going up through the roof. And as a consequence, the percent of household payments that went towards servicing debt reached all-time highs, precipitating the 2008 crash. Right now, our levels of household debt service are lower than where they were back in the early 1980s when rates were also really, really high. We're not in a bad fiscal position as a household. It's also important to note, and I'm going to reference Claudia Sahm here, a very good economist, a very famous economist. And although in aggregate, we look at our total, what's our total U.S. aggregate debt number is around $35 trillion. We'll round up $35 trillion. That's higher than it's ever been as well. When we run a deficit, when we spend more money than we take in as tax revenue, we run a deficit. A deficit combined with last year's deficit, the year before, all the way back in time, all those deficits added up as our national debt, something that we owe ourselves. And a lot of people say, is this a big deal or not a big deal? It will be a big deal for sure, for reasons I'll talk about in a second. Right now, it's not a big deal because yes, we have 35 trillion of debt, but we also have about 141 trillion of household wealth in the United States. And so when you look at it that way, it's a lot of money, but it's not as bad. It's not something that we have to, stay up at night for. But it is something we should try to get a handle on in the next 30 years or so. And why? Why do we care about the national debt? So I'm going to start with high-level debt, then we'll go back to household debt. When you look at interest payments on federal debt as a percentage of government spending, right now, because interest rates are higher, the amount of debt that we have is higher. We're anticipating in our June 2024 forecast that the household debt payments are going to rise from the 6% they were back in 2020, not household, but federal debt percentage of government expenditures. So each year, the government will spend 6% of its tax revenue on just paying down debt that we owe. Now it's over double that. It's over 12% now, and it will likely rise to 14 and perhaps 16% by 2030, maybe even more. That takes up a big chunk of revenue that we could spend on other things. Every other thing the government could spend money on, from Social Security to Medicare to other things that it has money on. And a lot of that's due to higher interest rates that we're spending, as well as more debt as a whole. So Albert says, I believe every American owes 100,000 right now if you're to divide that debt evenly. That's right. That's about right, because we have about 335 million Americans, give or take, $335 trillion of debt. That works out. That checks. So obviously you're in a situation where that's a lot of individual debt that we'd have to pay. But that's why Albert's list exists. Albert will happily pay off your part of the national debt at his leisure. So thank you, Albert. But one of the things that we have to worry about more close to home are our debt balances right now in our households. And we look at this, we've got mortgage debt, home equity revolving, automotive loans, credit cards, student loans. Right now, our total debt, about $18 trillion. And we've seen an expansion of credit card debt, which is expensive debt. That's unfortunate, but it's only a small percentage of our overall household debt. So all the stuff in orange, we typically have lower interest rates on. That's mortgages. The more time, the longer that rates remain higher, the more of a household debt expenditure this is going to become. Automotive loans have increased, but again, a small percent of the overall consumer matrix. And things like, home equity remains relatively minor. And why is this? So is this a debt crisis brewing? How are we with debt markets right now? Should we be worried? So one of the interesting aspects about mortgages right now, if you're buying a house, you almost exclusively have an incredibly high credit score. 760 and above are the majority of mortgage originations. And it's been this way since going back basically to, I'll call it evenly about years ago. So the quality isn't what it was 15 years ago when people with low interest rates, low credit scores were taking out mortgages. Now it's basically dominated by really, really good credit. And that means that these are people who pay their bills typically on time, and as a consequence, who try to, at least within this spec, they have good credit scores. So from a bank's perspective, they're people that live within their means, and they're able to do so, and it's pretty reliable debt. But it also means it's symptomatic of, I think, a division in our society where the only people that can really afford to buy homes have good credit scores right now. And if you're stuck in a situation where you're building credit and doing something else right now, you're renting, you're at the whim of a landlord, you're in a tougher position right now. And there's definitely there's been this split in what's been happening across the market right now. Oh, that's interesting. Yeah, there was a rumor about the Saudis abandoning the petrodollar. So as Albert points out, a lot of the Middle East, as a artifact of the Bretton Woods Agreement in 1944, which made the dollar the only currency convertible to gold, and every other currency on earth had to convert their currency to dollars to buy gold and other commodities. The oil prices are reflected worldwide in dollars. And so a lot of Middle Eastern countries have their currencies pegged to the US dollar in a very real way. And as a consequence, that gives the United States a lot of good benefits. However, the tendency geopolitically in the last few years has been to test US hegemony on the global currency and commodity markets. And so far, while Saudi Arabia could be like, hey, we're not going to be part of the petrodollar anymore or anything else, because it's so familiar and it's something that happens so easily in markets, and because international trade, when we look at international finance and currency exchange rates, the US dollar dominates every other currency on currency exchange markets. There is an incentive to keep commodities valued in dollars anyway, regardless of what Saudi Arabia chooses to do. And so Saudi Arabia can say, we're going to free float this, we'll do something else, but it's not fundamentally going to change the economic situation globally. There will be a time, more pressure will be on the US as time goes on to continue to devalue the dollar relative to other global currencies in this paradigm. But right now, one thing is that we haven't seen another currency rise to that occasion to be a competitor of the dollar. The euro did for a little bit before the 2008 financial crisis, and then since then it hasn't competed. And so it is a temporary phenomenon, but one that may last a few decades more. Or maybe it'll be gone in 10 years, depending on our geopolitical situation. Now, compare mortgages for a second to automotive loans. So mortgages, if you're buying a house, you got a good credit score. If you're buying a car, we have to buy a car. If you live in most of the United States, you don't have access to a lot of public transportation options. And you look at and you don't have a choice when your car decides to catch fire on the highway, what to do with it. And then, you don't have a choice on electing to not buy another car when something catches on fire if you want to get to your job and continue being gainfully employed for most of the country that don't live in places with reliable public transportation. And so people tend to need cars from across the spectrum. And you'll notice that the automotive market is much more evenly spaced with regards to credit scores. Meaning that there's a lot of people from across the credit score spectrum who buy automobiles. And these ratios have remained relatively constant over the last 15 years or so. But there is still, to this point, a greater ratio of these high credit scores than we've seen before. So another thing to look at, where are loans delinquent right now? Credit card loans are on the rise. Delinquency rates are increasing. That's bad news for the economy. Automotive loan rates are increasing. Bad news. Not at historic levels, not something to worry about, but it does show that consumer finances are getting, in general, even if dominated by relatively small numbers of people who are defaulting on these loans. In aggregate, it shows that consumer finances are getting weaker, and that is a source of concern for me, and one that I'm still evaluating. But home equity loans, obviously not very popular when rates are very high. Student loans, of course, having been paused for so long, kind of fell off of this. That's going to come back and we'll end up with delinquencies in a few years down the line. Now, okay, a couple questions from the audience on this one. Albert says, on the aggregate, loan defaults are low, but if you, the individual, are defaulting on your loans, your world is on fire. Absolutely true. So as much as I can say, oh, things are sunshiny and rainbows and default loans aren't that way, if you are defaulting, you're in a terrible economic situation, and that's something that can befall anyone. And the reason I'm in finance is because it befell my own family numerous times when I was growing up. Caroline says the Saudis are mining our water, draining the aquifers in Arizona, although companies that are growing hay for their dairy cows. Oh, that's interesting. I didn't know that. Very interesting stuff, Caroline. I've looked into that more. I don't know a lot about that. So does it pay to be ethical? So this is a question that I had. I love this one. I love the nihilist questions I get from Albert's list from time to time. And those of you, the 20 who are remaining in here, thank you so much for staying and rocking and rolling. So does it pay to be ethical given all the stuff that's happened with Boeing? So yes, in short, two pieces of data for you. One is from the Ethisphere, which determines the world's most ethical companies. And they note that their companies that they track have a 5-year ethics premium of 12%. They outperform other companies that they don't deem as being ethical. On another level, on another finance research level, Zuari, Zadaji, and Chuaibi noted that they based some research on a sample of 80 firms and looked at ethical firms had lower costs of capital, which means that anytime they wanted to raise money for an investment, they had a lower interest rate. And as a consequence, that benefits their profitability and benefits their margins over the long run. Albert says, Boeing CEO admitted to retaliation in front of Congress for the whistleblowers. That's true. I read that. So does that make them guilty as an accessory to murder since people literally died? I have to see how this pans out literally. So if you're Boeing, either you have the worst luck in the world or you're a unfathomably corrupt institution. And it's probably a combination of both. But I think it truly is evident that in the long run, so if you're wondering about this in your own company, it does benefit you to be ethical. Now, the question of ethics is different than the questions of, say, ESG. That's not measuring the same thing. So ethics is a much more a values-based approach that differs in perception from an individual level. We have some metrics. We have things like in investing, we have impact investing. We have, responsible investing, which includes things like impact vesting and ESG-based investing. That's not the same as being ethical per se, but there is, so there's a lot of mixed research on this and how that performs and how people define what ethics is, which is always worth talking about. So one question kind of across too about sort of where the economy is going to go and what's going to happen. Will the Magnificent Seven stocks continue to rise? So this is some data from Dimensional Funds. So on the left here, before they joined the 10 largest companies, companies really did well. But when companies reached a level where they were part of the 10 largest companies, they started to do really badly in the long run. And when we look at other things like yield curve inversions, like the one we've had right now, where short-term rates are higher than long-term rates, Usually, this does result in a recession, but it's been inverted now for over 500 days and we haven't had a recession. And this is, if it does end up not being a recession, this is the first time on record that would be the case. Some notes. Election years. What does that mean for the economy? Historical election outcomes and market performance. So in this case, in short, it's a complex series of data. Hold on, let me say goodnight to my son. That's rock and roll. My 10-year-old son, James. Good night, my boy. Have fun. Dream about finance, son. So we have these historical election outcomes, market performance, highly variable, as it turns out, when it comes down to a number of things. So if you have a Democrat in the White House and Democrat in congressional control, the average 3-year S&P 500 during the period is 2.2%. The highest ratios, and this is where we start dividing data so much that it's no longer useful to reflect them. If you've got a Democratic president and Republicans controlling one of the legislative houses and Democrats controlling the other, you got a 4% increase. And then, you've got, it's just, even explaining this is ridiculous because they're heavily weighting on a couple of very specific situations in time in elections that this happens. But you asked, and this is what you get. There's a lot of noise here. So in essence, a Republican president and a Democratic Congress produces the lowest S&P return. A divided Congress produces, on a specific level, produces the highest one. Both of those are statistically significant. But again, I've written a lot of articles with statistical significance, and I'll tell you there are some issues there. Now, when it comes down to the economic regime, we've got falling inflation, but we also have falling growth rates. So we actually don't have a combination that combines both falling growth and falling inflation here. But it shows you that depending on certain economic states, this also affects outcomes in the election year. No, that's right. I'll be telling you, there's nothing you can do about this from channeling your butt. There's nothing here that will help you make decisions when it comes to the economic performance over the next 5 years. We're literally, people love studying this, but so I'll tell you right now, our sample size data, even if we go back in time, the modern post-war economy, no, damn lies and statistics, Caroline. No, my issue is we just don't have enough time to actually follow this through regularly. If you look at the physical number of data points, you're really limited to the physical number of elections that we've had. So even in, if we limit ourselves to the last 100 years and limit ourselves to the 50 elections of both president and Congress that happened in that time period, that's still not quite enough data points to present a perspective in a modern viewpoint to control for all the variables that we have. But it's still really, really interesting. It's interesting. So you got some interesting stuff. So I had some other specific questions that dealt with, hey, let's look at IT. Let's look at the tech occupation. Let's look at industry jobs. How's IT going to do? How are things going to happen? And the best part about looking up reports about IT is IT. God, I love IT workers. They're the most, they're not optimistic when you talk to them in the workplace, but man, are they optimistic about their performance in the long run. So even though 2023 was very disappointing for IT workers in San Francisco, San Jose, and the rest of the country, everyone's saying 2024, that's going to be our year. But what's the logic behind that? So you've got a lot of pressures that suggest that continue applications in AI, cybersecurity in particular, all that stuff the demand is always going to be there and it's going to continue to grow in meaningful ways. I do believe that's true over the long run. I'm not as confident as this report is that it will turn around in 2024 because companies are making investment decisions depending on things like rates, depending on availability of capital and where they stack capital. There's a few combos to look at. The GOP didn't hold the House between 1952 and 94. That's right. You're absolutely right, Albert. There's all kinds of, there's just things in this report. And this is my favorite part: employer hiring activity via tech job postings, new tech postings, and active tech job postings. My favorite part is going down, but wait, 2024, we're just going to change that trajectory abruptly. I don't see that happening, but I do see that we're going to level off here, and the IT trend that we've seen lately is going to improve. All right. Did I miss any questions that you've asked so far? We're at 8:23. I want to point out two quick things on San Francisco and San Jose. After increasing your unemployment rates for a couple of many months now, in fact, unemployment rates dropped in both San Francisco and San Jose. Yay, down to below 4%, even below the national average. However, it's for all the wrong reasons because the physical size of the labor force shrunk, which meant that at some point, 30,000 people in San Francisco and about 11,000 people in San Jose dropped out of the labor force, which means that your unemployment's going down for all the wrong reasons. So anyway, so when in doubt, leave the workforce. But this is a concern. One also note as well, information, of course, still bleeding jobs in San Francisco and San Jose, dropping by 300 and 500 jobs in both areas in the last month. Okay, what did I miss? What do we got? Any questions? Any things? What's happening? What's in your neck of the woods? Thanks for sticking along this long.
So what's the good news then?
What's the good news? Okay.
Is there good news?
The good news is it's not bad as it would be, as bad as it could be.
Even for the information people who feel like they haven't gotten a break in a good year.
Information hasn't gotten a break, and they won't get a break. It won't cease. I'll bottom line this. Here's what has to happen. We need an injection. We need companies to have a compelling reason to make a widespread investment in the information sector, which will happen if the Fed can help signal lower rates. Those investment rates come down, building, we get into a position where companies can be strategic about their capital allocations in a way that looks towards expansion rather than contraction. And we haven't got there yet. Womp womp.
How come Jerome Powell doesn't look at like individual segments of the labor force like information and maybe say, oh, they look like they're suffering. Maybe something needs to happen.
I'm sure he puts it in a cigar and he smokes it. I mean, I'm pretty sure he's like information. I don't Google anything. No, I believe. So here's the thing. Here's the outside of the information bubble. He views, he's going to view information like many people do in the sense that it is always a boom and bust sector. Always is. We just happen to have a lot more boom than bust in the last bit of time. But it's boom and bust in the sense that is by nature, to be innovative, to draw capital, to be a source of innovation and growth. By nature, you're going to have boom and bust periods. Right now, it is absolutely a more bust period than we've seen in some time. Oh, Albert, you're watching. Do you watch all the FOMC press conferences? Isn't it great? Isn't it just?
Gosh, he just he reads off his piece of paper. And then he gives dry answers to the press. Like, is this like literally like that?
No, we've got. That's the thing. I think
we looked at the short-term rates and we looked at the short-term indicators, and they seem to be very healthy. And he just it's at the same tone the entire time. I'm just like, wow, what excites Jerome Powell? Does he go fishing? Does he, does he go? Does he like jump out of airplanes? Like, anything?
He likes to punish the information sector. That gives him joy. He watches the San Francisco Fed reports and he smiles. I think to your point though, you're absolutely right. It's dry. I don't know. I think it's going to be a long deal for us to make it on the board of the Fed one day. It's going to be hard for us, Albert. I don't know. We'll do it.
Are you noticing more job losses due to AI?
Interestingly, tough to tease out right now. I saw somebody take a stab at that question. It's incomplete data, incomplete information. I argue, I'm not Malthusian in this. I think that I'm sticking to what I said a few months back, which is the telephone operator story. They solved the question of the need for telephone operators in the 1920s. They still had operators till the 1980s. AI is great. It's fun. It's new, but it's novel. And we know it has we know many ways it could have a practical application, but those practical applications have not been realized. It's going to take a decade or two to really see movement in that sector.
And I hope I'm out of the workforce by then. I really do.
But it's the whole thing. The whole thing, it's not going to do it. It's going to increase productivity. I'm optimistic about AI. I think I'm more on the side that it's going to increase aggregate productivity. It's going to help us as a tool in our daily lives, getting rid through the chaff and the BS of the emails in a way that maybe we can handle better. but I think it's not going to result in mass job losses in like a Thomas Malthus sense.
Hmm. Hmm.
Are you more negative? I love if you are. I love to have this.
Well,
Is happening?
I work in the industry, so I can't
Yeah,
exactly
tell me.
hate it for what it is. I think from an economic standpoint, the thing I really hate is how much we've been able to increase productivity since the Reagan era and how salaries have not kept up, right? So like we can all be more productive and we may end up getting our 4-hour work week, but we won't get paid for that fifth day, even though we're just as productive, if not more.
Got something for that. So let me just one of the cool things you can check out on the economic. I'll drop this link into the hosts and panelists. I'll drop it to everyone. Hold on, let me try that again. So drop it in there. And what you can do is you can go to the Economic Policy Institute. They talk about the productivity pay gap, which is really interesting. That's
Mm,
also true. And so this is kind of a version of the chart that Albert was describing, productivity rising since basically 1979. But look at the pay. The pay's not following suit. And so as a consequence, how do we transfer that? How do we, and
mm,
there's a lot of issues with that too. So this
yeah.
chart, incidentally, and this is a big one. We should go into depth about that over one segment.
Yeah, we
One
should do that
is,
because I think that everything you
yeah,
point to in terms of labor ills in the last 45 years is either a Nixon or a Reagan policy, right? Whether it's Reagan's tax cuts and bringing down the top marginal rate from 80, 90% down to like the 30s, or the busting of unions or any of those kind of things, right? I'm not to get political, but just observing that as seemingly the trend.
oh
So,
yes. And
yeah.
you're right too. And this is one riddle of any economic situation. Look up Baumel's cost disease. So high productivity sectors versus low productivity sectors. High productivity sectors, for instance, tech. You produce a lot of things, productivity growth increases. It makes sense that pay in these sectors increases corresponding with higher levels of productivity. However, we find that because of the way the economy is interconnected. Like, for instance, if I'm working in a low productivity sector like retail, I could take a job in tech because I see it's paying me more money. Retail then has to fill my job, and they got to be more competitive to do that and offer a higher wage. And so, though retail's not increasing productivity, pay's also going up there as well. Higher education, a great example. If you're a professor somewhere, if you know a professor, but there's a situation where productivity has been flatlined for decades, but pay has yet increased, costs have yet increased. And
Mm.
so we have all these different elements here about the relationship between productivity, pay, and the rest of the economy that are just fascinating to discuss. So Baumel's cost disease. Know it.
Yeah.
It's your friend, it's your enemy. It's why they compensate me so
What
much.
are you expecting between now and the next time we meet, which is July 29th?
Hopefully, there's no economic crisis. Hopefully, inflation doesn't bounce back up. I think we're going to continue to see that drop a little bit. I'm interested in the jobs market. I still think we're going to see no good news on information, and we're going to see healthcare and leisure and hospitality take it again. I'd be really surprised if we hit 275 in the jobs numbers. I think it's going to be lower still. I think there is still downward pressure. We're still weakening, but the trajectory is choppy. So that's my prediction.
You say you don't expect an economic crisis. Does that mean that there are the odds of one are actually there?
Yo, what does that mean? Because that's what is Reilly? I'm not like I'm like Puxatani Phil. Did he
Are we
see his
buying puts on
It's
something?
like-
Are we buying calls on the VIX index?
Did I buy what did Riley's portfolio look like? Is he buying puts on VIX or is he buying calls on VIX? You tell me. Oh man, Albert, that's a great question. No, I don't expect it. I'm hopefully not to. I'd like us to avoid a geopolitical conflict that would destroy the economy. But I like a war, a massive war is always terrible. But
Yeah.
other things, but it could be oil crises related. It could be other things that cause this. But we aren't expecting it. We don't have a lot of incidents. There's not a lot to suggest. We've seen bank failures occur periodically, but we're not in a systematically bad place with banks. So, and that's the fuzzy part. We endured some things, but we're not being tested really. So that's why I don't feel like we're on this verge of a collapse right now. I know a lot of people feel that way, but I think that I'm optimistic that when we're back here in July, we'll be talking about the same thing.
Gosh, the same thing.
No.
Yeah.
The Willie.
So,
Excuse me.
so final question for the job seekers, both watching this now and watching this later. Are we giving the same advice for the next month? Because I feel like we've been giving the same advice for the past few, given that we're not doing anything. We're not lowering rates. We're not raising rates. It's just
No.
staying put.
Holding pattern in Albert's list too. So if you got job seekers out there, so that my point is don't give up hope. Don't become embittered by this. And I say these things over again because I have to say them all the time. I ran into this because I run into students who have a master's of cybersecurity and business analytics. That's our closest injection of tech in here. And I'm like, you could do job X, Y, or Z. And they're like, I only want job X. So please, and I say this over and over again, your experience, you've got skills, you've got skills that are good cross-sectionally and across the board in industries that you haven't thought of. Give it a go. Upskill, try. You're unique, you're fun. Get somebody to review your resume and write a kick-ass cover letter even if nobody reads it. Tell them who you are and what you're about. That's going to help you in the job market.
Okay. All right. Well, we will be back. We will be back here July 29th. So hopefully things get better. My fingers aren't crossed about it simply because there's a lot of volatility and everything. And so with that said, Dr. White, I want to thank you again for coming here to offer your insights, offer your thoughts. I did just drop the link to next month's webinar in the chat, July 29th. That's a Monday, so you get to start your week with Dr. White before we hit August. If you have any questions before then, feel free to send them to me or Dr. White on his LinkedIn profile. We will have this posted on our YouTube channel as well within the next day, so you can watch a replay if you have anything that you missed. Between now and when we meet next, want to just wish you a good time with wherever you may be in your career, and we will see you soon. So thank you so much, and have a wonderful rest of your week and weekend. Goodbye, everybody.
Thanks, everybody. Thanks, Dora. Thanks, Ricardo. Thanks, Aaron. Great to see everybody.